you said a lot of people from leaving a job that had a 401k will just convert it over.
Right.
How does that work? Any kind of retirement vehicle you had, you can just convert and
you can
all of a sudden make it self-directed?
Right. So a lot of people will call us and they're still working for the company that employs them and they want to move that money over. But they're not going to be able to do that. Their plan won't release them unless they're 59 and a half, or maybe they work for company A that got purchased by company B. Then they may be able to do what's called an in-service transfer. They're working there, they're in service, and they can roll their money over. Otherwise, you have to wait till you leave service of the company to be able to roll that over. So you open an account, call your old employer's plan administrator and say, I'd like to move my money. Here's the account. They move them. It takes about 2 weeks, but then the money is moved over. If it's an IRA to IRA transfer also takes about 2 weeks, but it's a little different. They fill out our form and they sign it, give it to us, we sign it, we send it to whoever's holding their IRA money today. A couple weeks later, their money comes into their IRA. So a rollover is an employer plan, a transfer is IRA to IRA.
Does it matter if a person's self-employed or not, like through a SEP IRA?
Yeah. It doesn't matter. You can self-direct a traditional, a Roth, a SEP, a simple, a spousal IRA, an inherited IRA, and we even have the solo K, a 401k for individuals who are self-employed with no employees. No.
Before we started taping, we got involved in this conversation regarding a mortgage fund versus trustee investments. And although you could potentially make more money, assuming nothing goes wrong, on an individual or trustee, in regards to it being a self-directed IRA, there is an advantage of it being in the mortgage fund versus in an individual trustee. Can you talk about that for a minute?
Well, you were talking about transaction costs with Kaaren and the offset of a $30 fee for every time you were to reinvest. If you had say $50,000 or $25,000 in a mortgage fund, and the distribution was $200, right? Your monthly distribution, that $200 would go back into the self-directed IRA. In order for you to reinvest that $200, it would cost you $30, right? Mm-hmm. So then you're thinking, well, if it costs me $30 to reinvest $200, how big a return, or how long am I going to have to wait to make that up? Right, so it's not cost effective to do that. And on an individual trustee, that's kind of the way it happens. The interest payment every month comes in and then is distributed back to the IRA custodian. That's where it always has to go. In the fund, you can compound it. The fund just rebuys new shares with each month's distribution, or growth is what it's called. So it compounds. Your whole $200 would be reinvested, and you would earn 8% on that $200, as opposed to $200 going into the IRA custodian and then being reinvested, where you're only netting $170 because you're paying a $30 fee for a transaction. And you wouldn't do that. You'd have to wait for your $200 to pile up to a point to where it's 10 grand or some critical mass that's large enough to absorb a transaction fee.